Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us from the MarketSite studio in Times Square, New York City, we have Frank Gannon, co-chief investment officer at Royce Investment Partners, and we're going to talk about small caps today. Yes, small caps and a bullish pattern that supports the outlook for the long term. Frank, it's great to see you again. Welcome back to Trade Talks. Obviously, small caps have been overlooked compared to the larger caps, but you're starting to see more interest in small caps, particularly the Russell 2000, and you also have a historical pattern that supports a bullish outlook more longer term. Yeah, there are two historical patterns setting up that I think are interesting. One is kind of simplistic, right? Low returns are followed by higher return periods, and we went back and did a historical study looking at the Russell 2000, and we found that the average 5-year return of the Russell is close to 10%. And when you see the return now below 5%, it's about 3% today, the next 5 years are above that average and close to 15%. So we think that's aligning quite nicely with a rebound in small caps and what we believe will be the beginning of a new small cap cycle. And we're supported by that with this idea that when you see such high concentration in the S&P 500, close to 25%, over 24% today, when you've seen that in the past, you see the relative performance of small versus large change dramatically. So we saw that the last time it was this high was, believe it or not, back in the Nifty 50 in the 70s, and then obviously after the tech bubble in 2000. But you see this relative small cap, large cap performance shift dramatically, and large takes off. In addition to small takes off. In addition to the historical performance, what other factors from a fundamental perspective are contributing to small caps looking more attractive relative to the large caps? Yeah, obviously valuation. Valuation, small caps are quite cheap. We use a EV to EBIT measure to kind of level the playing field, if you will. But if you go back and you look at 25-year averages, small caps are trading well below their 25-year average from the EV to EBIT standpoint today. Large caps are trading well above. And if you look at the relative performance of small versus large today, you'd see we're trading at a 2 standard deviation moment, which takes us back to where we were over 20 years ago. So the valuation opportunity within small caps today is a major factor. Yeah, the dot-com bubble, 20 years at this point. Is this just a U.S. play, or is there an opportunity in international small caps? The same historical pattern is setting up outside the United States. So we did the exact same study we did on the 5-year returns, looking at the MSCI ACWI small cap index. And what you find is when returns are as low as they are today, which are about 2%, believe it or not, over the past 5 years. Anything below 5%, you see the next 5 years being above the average. The average return for the MSCI ACWI Small Cap Index is about 6.7%, but what the study shows that the next 5 years will be close to 15% as well. So it's aligning both outside the United States for small caps as well as the United States. Any specific sectors that your portfolios are tilted towards? Yeah, we're, believe it or not, positioned more towards the economy, right? Economically cyclical, industrial areas of the market, those areas of the market that have been hurt by the fact that small caps have priced in a recession that for all intents and purposes have not yet materialized. So think industrials, think materials, think some financials, not banks all per se, but different areas of financials, insurance companies, capital market businesses, et cetera. So there's a lot of opportunity in small caps today in a world that everybody's trying to find the recession that for the moment is not existing. When small caps participate in the recovery, does that suggest the economy is improving as well? Typically what happens in a recovery, and I think, I've been calling it, we should be talking more about the recovery than the slowdown, because we've been talking about a recession now for close to 20 months, and your companies are pricing that in. Companies are acting as if there's going to be a slowdown. So earnings are probably not going to be as bad as many people think. But as the economy broadens out in terms of where the strength in the economy is going to be coming from, you're going to see it in different sectors, and that helps push small caps higher, typically coming out of recessionary periods, should we have one. I would imagine management teams want to manage risk really closely right now. I mean, especially because of interest rates, they move so fast at such great speed, and 500 basis points that they're cautious about that. I mean, 9 months is a lot to make that adjustment. But it's been longer than that, right? We've been talking about a recession going back for 20 months now, it seems like. Right. We've been in a bear market in small caps for close to 18 months. So I think management teams have been talking about it, preparing for a potential dislocation should it happen, but it has yet to materialize, as you've seen by some of the recent economic data. All right, Frank, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.